A backtest that looks perfect is often a trap. Many quantitative strategies fail in live markets because they fit historical noise, not real patterns. The quant world has a brutal joke: the more perfect a backtest looks, the faster it dies in live trading. According to research from DeepQuant, a major quantitative platform, roughly 70% of quantitative strategies fail in live markets because of overfitting. And 70% of so-called high-return strategies deliver less than 30% of their backtested returns when traded for real. These numbers are not precise statistics, but they capture a widespread experience. The mechanism is simple: when you fit a model to historical data, you might be capturing the market's true behavior, or you might be memorizing the random noise of that particular period. The latter is overfitting. Overfitting occurs because historical data contains both signal and noise, and a complex model can easily fit the noise. This leads to a strategy that is tailored to past randomness, which does not repeat. The consequence is that live performance diverges sharply from backtested expectations, often resulting in significant losses. This is why many quant strategies fail despite impressive backtests. Overfitting comes in 3 layers. The first is parameter overfitting. Imagine a moving average crossover strategy. A moving average smooths out price data to identify trends. If you tune the fast moving average to 5.37 days and the slow one to 21.89 days, with such precise decimal points, you are almost certainly tailoring the strategy to one specific historical period. The market does not care about 5.37 days. This precision is a red flag. It means the optimizer found a combination that worked perfectly on past data, but that combination is unlikely to repeat. The strategy becomes a custom suit for a ghost. Parameter overfitting arises when you optimize parameters to maximize backtest performance, often leading to overfitting. The mechanism is that the optimizer exploits noise in the historical data, finding parameter values that happen to work well but have no economic basis. This results in a strategy that is fragile and fails when market conditions change. The second layer is feature overfitting. This happens when you include variables that have no economic logic. For example, some researchers have thrown in the temperature in Washington, D.C., or the mortality rate from heart disease as predictors for stock prices. The backtest looks fantastic because the model finds spurious correlations. But these features have no causal link to markets. When live trading begins, those correlations vanish, and the strategy falls apart. The lesson is that every feature should have a plausible economic mechanism. If you cannot explain why a variable would affect prices, you are probably overfitting. Feature overfitting occurs because the model can exploit random correlations in the data, especially when many features are considered. The mechanism is that with enough features, some will appear predictive by chance, but these relationships are not stable. This leads to strategies that perform well in backtests but fail in live markets, as the spurious correlations do not persist. The third layer is structural overfitting. This occurs when you use a highly flexible model, like a long short-term memory network, or LSTM, or a transformer. These are powerful machine learning models that can capture complex patterns. But financial data has a very low signal-to-noise ratio. That means the true pattern is weak compared to the random fluctuations. High-dimensional models have so many parameters that they can easily memorize the noise. The result is a model that performs brilliantly on historical data but fails in the real world. The solution is to prefer simpler models, or to use rigorous validation techniques to ensure the model is not just memorizing. Structural overfitting is common in deep learning, where models have millions of parameters. The mechanism is that the model has enough capacity to fit the noise, and without proper regularization or validation, it will do so. This leads to poor generalization and live trading failures. How can you tell if a strategy is overfit? One powerful test is parameter sensitivity. If a tiny change in a parameter causes a huge change in performance, that is a classic fingerprint of overfitting. Consider a dual moving average strategy. When the fast moving average is 20 days, the Sharpe ratio is 0.18. The Sharpe ratio measures risk-adjusted return. If you change the fast period to 18 days, the Sharpe ratio drops by 58%. If you change it to 22 days, it jumps by 141%. That is a wild swing. A robust strategy would show gradual changes, not cliffs. This sensitivity indicates the strategy is tuned to a specific historical path. The mechanism is that overfit strategies have sharp peaks in performance at specific parameter values, so small deviations cause large drops. This is because the strategy is exploiting noise that is specific to those parameters. In contrast, robust strategies have broad performance plateaus, so small changes have minimal impact. Overfitting is not just an academic issue, it has a real financial cost. Suppose a backtest shows an annual return of 500% with a win rate of 99%. That sounds incredible. But in live trading, the strategy loses 70% of its value in just 3 months. This is not a joke, it is a real case exposed on the DeepQuant platform. The developer had secretly used future data in the code, meaning the backtest was effectively cheating by looking at the answer key. This is an extreme example, but it shows how overfitting can lead to catastrophic losses. The cost of overfitting is not just underperformance, it can be the complete destruction of capital. The mechanism is that overfit strategies are not robust to market changes, and when live trading begins, the assumptions break down, leading to losses. This case highlights the importance of ethical practices and rigorous validation to avoid such disasters. Why is overfitting so common in finance? Because financial data has a very low signal-to-noise ratio. The signal is the true predictive pattern, and the noise is the random fluctuation. In finance, the noise is huge compared to the signal. This makes it easy for a model to mistake noise for signal. The signal-to-noise ratio can be estimated as the variance of the true signal divided by the variance of the noise. A low ratio means that most of what the model sees is noise. To avoid overfitting, you need to be conservative in model complexity and use techniques like cross-validation, which tests the model on unseen data. The mechanism is that with a low signal-to-noise ratio, the model has to be simple enough to capture the signal without fitting the noise. Cross-validation helps by evaluating the model on multiple data splits, ensuring that the performance is consistent and not due to a particular sample. Here are the key numbers from our discussion. A 70% failure rate for quant strategies due to overfitting. A 70% shortfall in live returns compared to backtest. A 58% drop in Sharpe ratio when the moving average changes by just 2 days. A 141% increase when changed by 2 days in the other direction. And a 500% annual backtest that lost 70% in 3 months. These numbers illustrate the fragility of overfit strategies. They show how small changes can have dramatic effects, and how backtest performance can be misleading. The 70% failure rate indicates that overfitting is a widespread problem, affecting the majority of strategies. The 70% shortfall shows that even successful strategies often underperform expectations. The Sharpe ratio swings demonstrate the sensitivity of overfit parameters. The 500% backtest case is a stark reminder of the potential for catastrophic losses. These metrics underscore the need for robust validation and skepticism. My backtest shows 500% annual returns. This is incredible. But did you check for look-ahead bias? I'm sure it's fine. The strategy is perfect. Then why did it lose 70% in 3 months? I must have used future data. I was too eager. Overfitting is a trap. Always validate on out-of-sample data. So, how do you build a robust strategy? First, keep models simple. A simpler model is less likely to memorize noise. Second, use out-of-sample testing. Split your data into a training set and a test set. Train on one, validate on the other. Third, use cross-validation, which repeatedly splits the data to ensure stability. Fourth, avoid too many parameters. Every additional parameter increases the risk of overfitting. Fifth, ensure every feature has an economic rationale. If you cannot explain why a variable matters, do not include it. Finally, be skeptical of backtests that look too good. If it seems too good to be true, it probably is. These practices help ensure that the strategy captures true patterns rather than noise. By following these guidelines, you can reduce the risk of overfitting and build strategies that are more likely to perform well in live markets. Overfitting is the silent killer of quant strategies. It turns a perfect backtest into a live trading disaster. We have seen the three layers: parameter, feature, and structural. We have seen how a small change in a moving average can swing the Sharpe ratio by over 100%. And we have seen a real case where a 500% backtest lost 70% in 3 months. The key takeaway is to respect the noise. Use simple models, validate rigorously, and question every result. If a backtest looks too perfect, it is probably overfit. Build strategies that can survive the real world, not just the past. We appreciate your support. The final message is that overfitting is a serious risk that can be mitigated with discipline and skepticism. By focusing on robustness, you can improve your chances of success in live trading. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.